For every £1 of economic activity in the UK, the government collects roughly 37 pence in tax. This adds up to around £700 billion each year, which would be the equivalent of about £11,000 per person if the bill was split equally. The question is, where does all this money come from? And how much are you chipping into this pile? Let's imagine that this pie is the government's total tax revenue each year. The biggest chunk of tax revenue, around 40%, comes from taxes on people's incomes. This includes both income tax and national insurance contributions. If you're an employee, this is the money that comes out of your payslip each month. So where is the rest of the money coming from? Well, about a quarter of the money comes from taxes on things that people buy. This includes VAT, which is raised on most things we buy, from pens and chocolates to cars and fridges. It also includes some specific taxes, for example those on fuel, cigarettes and alcohol. Together, taxes on income and consumption account for around 2/3 of tax revenues. The government gets another decent sized chunk from taxes on property. Now you're probably familiar with the council tax. That's the tax that most of us have to pay to live in our homes. But the government raises just as much money from a similar tax on businesses called business rates. There are a bunch of other smaller taxes, including those levied on the value of some assets when they are bought, sold or passed on. And finally, there are other sources of government revenue, like rent on government-owned buildings. Who is actually paying these taxes? This can be tricky to answer. It doesn't matter who hands the money to the government. What really matters is who has ultimately got less money in their pocket as a result. This is sometimes easy to work out, but not always. Let's take corporation tax. Companies pay tax on their profits, but when you think about it, companies are nothing more than groups of people. A tax on profits can mean lower dividends for shareholders, but it can also mean lower wages for workers or higher prices for customers. So indirectly, most of us are paying corporation tax in some way or another. Now with income tax, it's easier to see the burden. If it's your income that's being handed over, you're clearly the one being made worse off. But income tax isn't shared equally across everyone. Around 40 out of every 100 adults in the UK don't pay income tax, either because they're not working or their income is too low. If you are earning, then the more you earn, the larger the chunk of your income is taken in tax. Economists often refer to income tax as progressive, and all they mean by that is that the share of income taken in tax goes up as your income goes up. In fact, the top 10% of income tax payers, this is people earning over £50,000 each year, pay 60% of income tax. The top 1%, who are earning over £160,000, pay a quarter of all income tax collected in the UK. So with all taxes, we should always remember to ask who's actually being made worse off as a result of the tax. What has happened to taxes over time? The share of national income raised in tax has been slowly edging up in recent decades, and it's due to increase even further in future years. In fact, to the highest level in 30 years. And if we look even further forward, an ageing population and growing cost of healthcare means that there will be pressure to raise even more in tax. So it really matters where the government is getting this money from. There have been some major changes in the way that taxes have been raised over the last 30 years. First, while the amount raised from income tax has been quite stable, we are now more reliant on the richest income taxpayers. In recent years, increases in the tax-free allowance, that's the amount that you can earn before your income is subject to tax, have meant that fewer low earners are paying tax. At the same time, a larger overall chunk of income tax is paid by the top 1%. In fact, that's the largest level since the 1970s. Income tax is one of the main ways that we redistribute from the rich to the poor. Now, of course, it's a political choice about how much of that redistribution we want to do. But the fact that we're now more reliant on a small chunk of the population to pay all this income tax means that we're also more reliant on the fortunes of this high-earning group. While the share of revenues coming from income tax have been relatively stable, the shares coming from national insurance contributions have actually increased over time. We often actually tend to see chancellors do this. They cut obvious taxes that people recognise, like income tax, and they increase the ones that few people pay attention to, like national insurance contributions. And the same is true with taxes on consumption. Well-known taxes on fuel and alcohol have become less important sources of revenue. But at the same time, more obscure taxes like insurance premium tax are becoming more important. Most recently, there's been a big cut in corporate tax. The main rate has already come down from 28% to 20% and will fall to 17% by 2020. The hope is that lower taxes can encourage more business, higher wages, lower prices. But this policy change costs the government a lot. It's chosen to make up some of that shortfall with a host of new, smaller taxes, such as those on sugar. If the government wants to raise more revenues in future, it's going to have to look beyond those small taxes and back towards the big taxes on income and consumption. This will mean that they'll need to be more upfront with the public about their tax changes.